Good evening. Hope you're having a good weekend. I wanted to talk today about the presence of the international equities within your overall equity portfolio. As you all know, India comprises 4% of the world's total market capitalization. The US is about 65%, and I think it'll trend towards 70% as Europe market capitalization decreases. So here's my 2 cents on international investments. So I believe the US will outperform, along with India, the rest of the stock markets. That's a function of, in case of the US, high degree of productivity, amazing innovation, enabling regulations, and a tax regime that's going to be very favorable to corporates. Some of those things are actually required in India, and perhaps they'll come with time. So I think the US is going to power on, and they have some amazing companies. And fortunately, we in India can participate in that journey of growth of those US companies via mutual funds based onshore in India. You might have noticed I'm not talking about the rest of the world, and the reason is very simple. I believe Europe is degrowing, and there was a traditional mantra of diversification. So you put your eggs in different baskets. But I think those who decided to do that severely underperformed internationally. For example, the S&P 500 gave a 25% return so far this calendar year. Those who chose to put half their money internationally in Europe or non-US jurisdictions probably got about 3 to 5%. So there's a big cost in following the diversification mantra. Conceptually, principally, asset allocation is correct, but today the reality is there are 2 markets and you should be in both of them. You must have your portfolio diagnosed via a hygiene check and see what is the percentage of international, i.e. US equity in your portfolio. The reason I keep talking about the US is if India is 4% and US is 65%, shouldn't you put more money out of every 100 rupees into the US? Most of us have 100% of our money in a 4% market cap, i.e. India. So that's conceptually wrong. We need to look at the various products available, and there are plenty of them. They cover NASDAQ 100, they cover the S&P 500, the Dow 30, the Russell 1000, the Russell 2000. And of course, the biggest benefit of these onshore India-based US investing mutual funds is you get the benefit of the dollar appreciation against the rupee, which, as we all know, is about 3 to 5% a year for the last 30 years. So do look at your portfolio. I personally put my money in the US, direct stocks, and that's another chapter and another story. But I also do indirectly through US ETFs. I also do that indirectly through India-centric mutual funds. And I think this is something you need to do pronto, because if you believe that you should not put all eggs in one basket, then your asset allocation country-wise might need to be changed in favor of the US. So think through it. It's a big change, a mindset change, but I think logic should prevail. Emotion should be put aside, and we should analyze this and maybe effect the changes in our portfolios. So guys, have a great weekend. chill, no more thinking, switch off, and have a great weekend. Take care. Bye-bye.